Very good morning to all of you students. Today we will again be continuing with the topic of derivatives. So students, in our previous sessions, we have discussed about the Black-Scholes model as well as the put-call parity theory. So there is one more question which is left, which will be a good practice for the entire Black-Scholes model as well as put-call parity theory. So let's do this question. Good morning, Shruti. Question number 15. The shares of TIC Limited are currently priced at 415. So this is our spot price. And call option exercisable in 3 months time has an exercise rate of 400. Good morning, Viraj. So the exercise price is 400 students. Risk-free interest rate is 5% per annum and the standard deviation, which is volatility of share price, is 22%. Based on the assumptions that TIC Limited is not going to declare any dividend over the next 3 months, is the option worth buying for rupees 25? So students, they have given us the value of this option that is trading in the market as 25. Okay. And they're asking us whether this 25 is okay or not to be bought at. Now this 25 is the market related price. We have to calculate the bottoms up price, or let's say the theoretical minimum value price, which is given by the Black-Scholes model. So before we start, students, I just want all of you to note certain values that are given. So which were missed, which I missed to put it in this question. Can you please mention this, all of you? So additional information. So this is as a part of the question itself, okay? Additional information. Yeah. So natural log of 1.0375 is equal to 0.03681. Good morning, Mansha, Tanisha, Shailesh. Good morning, everyone. Natural log of 0.95 is equal to minus 0.05129. Then natural log of 0.9952 is equal to minus 0.00480. And also e raised to the power 0.05 into 0.25 is equal to 1.012578. Then e raised to the power 0.05 into 2 divided by 12 is equal to 1.0083. So students, please note that this additional information is part of the question itself. Okay, this is part of question itself. Okay. So in the first part, they're asking us to justify whether it is worth, the option is worth buying at 25 or not. That we will be able to tell once we calculate the option value. So for the first part, applying Black-Scholes model, value of call option is equal to S into ND1 minus XE minus raised to the power RT ND2. Correct, students? I hope all of you would have done a revision after we discussed all this in our previous sessions. So D1 is equal to natural log of 415 divided by 400 plus 5% is the risk-free rate of return. 22% is the volatility, and time to expire is 3 months. This whole divided by 0.22 into under root of 3 by 12. Okay, Tanisha, thank you. Then log of 1.0375. Okay, which is this 415 divided by 400 is actually 0.03681, right? Yes. So using that, using that, the D1 becomes 0.03681. Okay, Mancha, no issues, but just do the revision as we go along the class. Good morning, Namrata. 0.03681 plus, if you solve this, 5% plus 0.22 raised to the power 2 divided by 2 into time. So this comes as 1865. This whole divided by 0.11, which is overall equal to 0.50327. So D1 is equal to 0.50327. D2 will be D1 minus volatility underscore T, correct? So D2 becomes 50327 minus which 0.11, which is the denominator of D1, correct? So from D1, if we reduce the denominator of D1, we will arrive at D2. This is 0.39327. So this is what the D2 is, students. Okay. Now comes ND1, which is actually N 0.50327. Okay. So just a second, let me go to the standard normal distribution table. Okay. So here we have to calculate the value of what? 0.50327. Correct, students? So we need something between 50. We need something between 50, 0.50 and 0.51. Okay. So 0.50 is this much. 0.69146 and 0.51 is this much. 0.69497. Okay, students. So let us mention 0.50 is actually 0.69146. 0.51 is equal to 0.69497. So using interpolation technique, 0. 0.69146 is the base value. Then the difference between these two values divided by these two values. Correct? 0.69497 minus 0.69146 whole divided by 0.51 minus 0.50 multiplied by, see where we have to reach students here, 0.50327 minus 0.50, which is the base value. Correct? So N D1 actually comes out as 0.6928. Okay. This is the value of ND1. So just to cross check, actually this value that we land up should be somewhere in between these two. Okay. Okay, students. Let's move ahead. Let's go to D2 now. So students, for ND2, we have N 0.39327. This was our D2, right? Yes. So we have to see the standard normal distribution table for 0.39 and 0.40. So 0.39 is 0.65173 and 0.40, which is 0.65542. Easy, students. We have to just find out just to highlight it again. So we have to calculate 0.39 and 0.40. Correct? This is what we have to calculate, students. So 0.39 is actually this value and 0.40 is actually this value. Okay. So 0.39 is 65173 and this is 0.65542. So if we use interpolation technique again, okay, so let's start with the basic value 65,173. Okay, this is the smaller value plus the difference between these two 0.655 65,173 0.65542 minus 0.65173 divided by 0.40 minus 0.39 multiplied by multiplied by where we have to reach 0.39327 minus 0.39, which is again the basic numbers. We solve this, then n d2 becomes 0.6529. This is the value of ND2. Now, can we calculate the value of call option? Yes, we can calculate the value of call option. Spot price 415 into ND1 6928 minus present value of strike price. So 400 divided by e raised to the power 0.05 into 0.25 multiplied by 0.6529. Yes, Mancha, very good. Okay, so this is the value. ND1 was 0.6928. ND2 is 0.6529. Okay, we will replace these values now. So this becomes 287.512 minus 400 divided by. So this value is also given in the additional information that I've just provided. So this additional information is this 1.012578. 1.012578 students. Okay. And 0.6529 remains as it is as of now. So hence the value of call option becomes 29.60. So this is the theoretical minimum value. So the theoretical minimum value is 29.60 students. Okay. Since now the market, the same call option is available at 25 rupees, I guess. Yes. So what should be your suggestion, students? Tell me. Market, it is available at 25. The theoretical minimum value of this call option as per Black-Scholes model should be 29.60. So whether you should purchase it or whether you should sell it. Come on, students, tell me. What should we do? Whether we should sell it or purchase it? Market, it is available cheaper. Our calculation says that it should have a minimum value of 29.60 students. Yes, thank you, Namrata, Tanisha. Very good. You are correct. Shailesh, you are also right. Since the value of call as per Black-Scholes model is higher than no Mancha, just check again. We will actually purchase it because it is underpriced. Okay. Sorry. Is higher than rupees 25. Hence, sorry, we recommend to purchase the option at rupees 25 since it is underpriced. Okay. Clear, students? First part is clear. Now let's come to the next part. Calculate the value of aforesaid call option based on Black-Scholes valuation model if current price is considered as 380. So instead of 415, they are saying that you assume it is now 380 and you recalculate the entire value of call option. Tanisha, which module are you referring to, Tanisha? Because ND1 and ND2, I have calculated it using the standard normal distribution table. Okay. And as I can tell you that the previous question that we did under Black-Scholes model, it was given in that question. The area from area one tail or area left to right, right? All those things will be given in your question paper. So it won't be at all difficult for you to calculate the ND1 and ND2. Okay. So yes, students, spot price, let's say it becomes 380. Okay. So D1 becomes natural log of 380 divided by 400 plus 5% plus 22% raised to the power 2 divided by 2 multiplied by time. Okay. This whole divided by 0.22 into 3 by 12. So hence D1 is equal to, now this natural log of 380 by 400 is again given in the additional information as this natural log of 0.95. Okay. So I will substitute this 0.05129 plus 0.01855 divided by 0.11. So this becomes minus 0.297836. Wait, student, this becomes 7636. Okay. And hence D2 becomes minus 0.297636 minus 0.11. So D2 becomes minus 0.407636. Okay, students, this is the D1 and D2. So Namrata is asking, in case in question, if we have been given area from 1 to right, then and we need 1 to left, right? So what we will do, 1 minus that area, whatever is given, will be your answer. See, as a principle, if you understand how does this standard normal distribution works, so it is exactly the mirror. So point 0.5, if you draw the middle line here, which is the mean, correct? If you plot mean and you draw a line here, so it will divide this into equal parts, 0.5 here and 0.5 here. And the total will always be equal to 1. So if you are standing here and you're getting any values from right till this, right? So for example, you are getting this value as 0.30. However, we have to okay, let me plot this point. This is called as B point, this is called as C point, and this is called as A point. Okay. So let's say BC is given as 0.30. We have to always use AB, and B is the point where Z score is, right? That Z score we have calculated, that will be this. So AB will be 1 minus 0.30, which is equal to 0.70. Okay. So this you can easily calculate. Okay, students. So this is a very standard functionality of a standard normal distribution table, students. From left to one is what we have to always consider. So that is what is mentioned in this table as well. Table values represent area to the left of the Z score. Okay. I hope this is clear, students. So now we will have to calculate the ND1 and ND2. Yes, students, ND1 will be N minus 0.297636 will be equal to what? And ND2 will be N minus 0.407636. Okay, yeah, thank you, Namrata Shruti. So again, now I am not calculating again using the interpolation technique, okay, that all of you can try at your end, because in all the three parts, then we will have to calculate ND1, ND2. So I'm just writing the ND1, ND2 value. You just calculate 0.3830. ND2 will be 0.3418. Okay. So again, using the interpolation technique, so students, if we use table and interpolation technique, we will arrive at 0.3830 and 0.3418. Okay, now let's calculate the value of call option. 380 into 3830 minus 400 divided by 1.012578, students. Correct? This is what? E raised to the power minus 0.05 into 0.25. Correct? 0.3418, students. Correct? So the value of call becomes 10.52, students. Can you see this? So when the spot price was 415 and now the spot price is 380. Okay. So here the value of call was how much? 29.60. Now it is 10.52. Can you see? For a call option, once the spot price decreases, the value is also decreasing. Correct? So here the value will decrease by how much? Almost 20 and 15, 35 rupees. Correct? And The drop here is also 29.6 minus 10.52, around 19 rupees. You're getting my point? So the value of call option has also declined because of the decrease in spot price. Let's move ahead, students. A part is done, B part is done. Now C part. What would be the worth of put option if the current price is considered as 380, students? Now, how will you calculate the put option, students? Yes, Namrata, lower the spot price, value of call decreases. Now tell me, students, the facts are given to you. They are asking us to calculate the value of a put option at a strike price of 380. How will you calculate? Is there an easy way to calculate? Come on, students, tell me. Can anyone tell me how we will be calculating the value of put option? No, which is fine, Namrata. In case this is a put option, the value would have decreased. The value would have increased. That is fine. But my question is, they are asking us to calculate the value of put option, the worth of put option. How we will be calculating that, students? What method or what formula should I apply to calculate the value of put option here? Basis the answers given, basis the facts given in the question. Namrata, you are perfectly right. Very good. Can anyone also attempt how to arrive at value of put option? Value of call option minus market value of present value is equal to value of put option. So, okay, Tanisha, good attempt. But I would say that let's straight away go to this is what we discussed yesterday, right? Yes, Mansha, you're right. I think, Tanisha, you have also tried. Your answer is also correct, Tanisha. Okay. So, using put call parity theory, we know that the value of put option plus spot price is equal to value of call option plus present value of strike price. Okay, students. This is using the put call parity theory that we discussed yesterday. Investor 1, investor 2, if they have different initial cash flows, however, they will be getting the similar cash flows uh, at the end of their portfolios, at the end of the tenure for which they are holding the portfolio. So then why would be their initial cash flows be different? Correct? So then we said that initial cash flows would always be equal then. So value of put plus spot price was how much? 380, right? 380 is what we have asked to assume. Value of call when the spot price was 380 is how much? 10.52 plus present value of strike price. Strike price was 400 into e raised to the power minus RT or divided by e raised to the power 0.05 into 0.25. Okay. I hope this is clear. So the value of put becomes 10.52 plus 400 divided by 1.012578 minus 380. Correct, students? So the value of put becomes 25 point, sorry. Value of put becomes 25.58. Okay, students. So the value of put, it becomes 25.58. Just a second, students. Yes. So the value of put option becomes 25.58. Okay. So can we say that if we compare this value of call option with the value of put option, can we say that since spot price is lesser than the strike price, hence put option is more lucrative? Correct? It is more beneficial as of now because if you see the strike price is how much? 400. The spot price is 380. So hence put option is better compared to the call option. Okay, students? I hope this is clear. Yes, next. Then the last part of this question. If TIC Limited's share price at present is taken at 408, now they have again changed the spot price and a dividend of rupees 10 is expected to be paid in the 2 months time, then calculate the value of call option. They are saying that there is a dividend that is expected to be paid in 2 months time, students. So then what happens? We have to reduce the dividend from the spot price to make it as a X dividend spot price. Let's see. Now let's come to D part. This is 2 months. This is 3 months. This is 0th day. So there is a dividend after 2 months, right? So the present value of dividend payout to be reduced from spot price for applying DSM. Okay. So, students, till now, we have been given the spot price and we were taking that as it is. But if there is a dividend likely to be paid, then we will actually reduce that. Okay. So let's first of all calculate the present value of dividend. 10 rupees is the dividend, correct? And it will be paid in 2 months. So e raised to the power 0.05 into 2 divided by 12. So 10 divided by, now e raised to the power 0.05 into 2 divided by 12, that part is given in the additional information, which is this 1.0083. Okay, students. So the present value of dividend is equal to, yes, Tanisha, very good, 9.917. Perfect. Now, adjusted spot price is equal to 408 minus 9.917. Adjusted spot price is equal to 398.083. Clear, students? So using this spot price now, we will apply the Black-Scholes model, students. Okay. I hope this is clear. Now let's apply the Black-Scholes model. D1 is equal to log of, natural log of 398.083 divided by 400 plus 5% plus 22% raised to the power 2 divided by 2 multiplied by time to expire is 3 by 12. Again, the same. This is the next part is always same. Okay. Okay, perfect. Under root of 3 by 12. So D1, if you see this, so D1, so this natural log of this figure is also given in the question. I think the last natural log which we have not used till now is this 0.9952, which is minus 0.00480. So D1 becomes minus 0.00480 plus 0.01855 whole divided by 0.11, which is equal to 0.125. Yes, Shruti, this is very long. However, this question covers your Black-Scholes model 3 times, right? One time with the application of dividend, 2 times normal calculation, and fourth time the put call parity theory application. Okay. Then D2 is equal to 0.125 minus 0.11, which is equal to 0.015. So ND1, ND2, N 0.125 and N 0.015 is equal to 0.5498. 0.5060. So the value of call is equal to 398.083 multiplied by 0.5498 minus 400 divided by 1.012578. Okay. In here, students, I have not used the standard distribution table and calculated interpolation technique. So this I have just straight away written the answer, but I'm saying that it is using table and interpolation technique. Okay. So this, if we multiply, it becomes 0.5060. So the value of call becomes 18.98 students. I hope this is clear. Okay, now just to summarize this bigger question. So when our spot price was 415, the value of call was 29.60. When it has gone down to 380, it became 10.52 students. And similarly, when it was 398.0, how much it was? 398.083. Then it came down to 18.98 from 29.60 students. So in a way, if you see, the prices of call option are moving in relation to the prices of the shares, or let's say the spot price. Correct? If the spot price is increasing or decreasing, similarly, it is having a similar impact. Now there is a concept called delta. Delta is equal to the change in value of call option divided by 415 minus 398.083, 0.6277. Okay. I will explain what is the delta, but from a mathematical standpoint, the calculation is like this. Let's say 380, 398.083 and 415. Okay. So here the value of call was 10.52, 18.98, 29.60 students. No, no, Namrita, first of all, see, this is not from this part that entire question will come in exam. For example, they might say that dividend is there, now you calculate the BSM. or now you calculate the delta. They might given you two parts and they will ask you to calculate delta. Okay. The question is over. I'm just trying to use this question to come up to the second topic of today's, which is the Greeks. Okay. And explain you better through this question itself. So students, I just want all of you to observe that against 380 to 398, what is the delta? Okay. First of all, before that, can we say that this is out of the money? Yes, we can say that can we say that this is at the money? I'm talking about approximates. Okay, and I'm not talking about the exacts. I'm talking about approximates. The strike price is 400. Anything at 398 will called be as at the money approximately. Anything more than 400 will be called as in the money, right? Can we call this? Yes, we can call this. Now, delta for the first movement from 380 to 398. Okay, for this, if we calculate the delta, it becomes 18.98 minus 10.52 divided by 398.083 minus 380. So delta means for every 1 rupee change in spot price, what is the change in the value of a call option? Okay, how it will move. So it becomes 0.4687. Correct? This becomes 0.4687. Okay. And if we have calculated already calculated this through this, right? So 29.6 minus 18.98 and this one. So this is 0.6277. So the delta is actually change in the value of a option compared to the change in the value of the spot price. Simple. Okay. Now, if you see students, the delta is also increasing. So delta starts from 0 and it moves to 1. And it moves to 1 when it is deeply in the money. When it is 0, when it is deeply out of the money. See, what will 1 mean? That for every 1 rupee increase in a share price, the value of the call option is also increasing by 1 rupee. Okay. So you can imagine a situation where a rupee change, a single rupee change in a spot price is also leading to a similar increase in the value of the call option. This will happen once you are deeply in the money, students, right? You have surpassed. So even let's say this comes to 500, for example, the spot price, right? So for every 1 rupee increase, it will give you a 1 rupee increase in the value of call option. Yes, Tanisha. Actually, we are seeing the reverse impact. We are seeing the impact of change in the spot price. It will take to the change in the value of a call option, students. Okay. I hope this understanding is clear. And similarly, if it is deeply out of the money, okay. So then also the value of call option will not increase. So let's say it is somewhere around 150. So if 150 moves to 151, the value of the call option is not going to increase at all. Correct, because it is 150 and 151 is same. So it is deeply out of the money. Okay, so it will slowly start increasing from 0 to higher number once the option also moves from out of the money to in the money. Okay, so delta is actually change in the call option price divided by the change in the spot price. Okay. Now let's talk about Greeks. So students, the Black-Scholes model, put call parity theory is over. Okay. The In fact, the options as an overall concept is also over, except for this last part, which is the Greeks. So please understand, students, this is some of the very interesting part that we are going to cover now. What are Greeks? Greeks are factors affecting the price of the option, which is premium, right? Price is called as premium. So any factor which affects the premium of an option is called as Greek. So the first and the foremost factor is what we have just now studied on, which is the spot price. Correct? Spot price, any increase or decrease in spot price will impact the price of the option. I hope all of you agree with me. So that measure is called as delta. Okay. So for call option and put option, can we say that this is the change in value of call option divided by change in spot price? Similarly, put option, change in value of put option divided by change in spot price. So the extent of change is actually given by delta. Okay. By what extent the change will happen is given by delta. And just to tell you, delta is also called as hedging ratio, was given in our Black-Scholes model as N D1 minus N minus D1. Remember, students? So in the Black-Scholes model, ND1 we said that is a delta, correct? Tanisha is asking the relevance of the spot price. Tanisha, see, the spot price will determine the value of a call option or a put option, because your exercise price, standalone exercise price, will not make any sense. The exercise price has to be compared to the spot price to arrive at the payoffs, correct? That is what we also do. Hence, the spot price is much relevant to arrive at the value of a call or a put option, students. Okay. So as I was saying, that ND1 that we use in the Black-Scholes model is called as the delta in a call option, and minus N bracket minus D1, which is used in the put option formula, is also used for the delta. So this is a positive value, students. And this is a negative value. So students, as we discussed that the delta of put option is negative, correct? Because for every increase in spot price, the value of put option will decrease. I hope you're agreeing with me. However, in case of a call option, the increase in spot price will increase the call option price also. However, delta for a call option is positive. So let's first explain why delta of a put option is negative, students. So the delta of a put option is negative because if spot price increases, the value of put option decreases. Correct? Similarly, the spot price decreases, the value of put option increases. I hope all of you are able to make it. Now, in case of a call option, if the spot price increases, the value of call option will also increase. It has a direct correlation. If the spot price decreases, the value of call option will also decrease, students. Okay. I hope this is crystal clear. Okay. Now let's try to understand delta from this below chart. So call option, and we are talking about buyer. So this payoffs we have already discussed, correct? This is the payoff and this is the price, correct? And we said that for a call option holder, it will start like this and it will move on to like this. Correct, students? Till now here with till now, I hope all of you are there with me, students. Then it was 10, 20, 30, 40, let's say 50, 60. And here we said that it was 45. Why 45? Was because of the premium, sorry, because the strike price and premium, right? Strike price was 40. So if the spot price reaches at this value, which is strike price plus premium, then it will be zero gain, zero loss, which is given here, right? 40 plus 5, 45. Okay. Now, students, if you see, it is till here out of the money. Then slightly it is at the money. Then it becomes in the money. Correct? So that is what we discussed, students. Now, let's come the so now comes the final concept, right? So the delta is 0 when the option is starting from out of the money and slightly increases from 0 to 1, while the option moves from deep out of the money to deep in the money. I hope this narration is clear. Yes, this narration is clear. So basically, see delta. There is one more way to say. Okay, you just all of you just mention this. Then I will just tell you. So this we have just now proved with the previous example also, students, right? Where we have been moving from out of the money to at the money to in the money, and hence the delta was also seeing increasing. So if you see, students, in this payoff, it is going like this, right? The diagram. Delta is what? Delta is actually the slope of below line, correct? So if you see delta, while it is out of the money, which is equal to slope, is actually zero. Because if the slope is zero, the line becomes horizontal, right? Here, the slope is actually greater than zero, but less than one, correct? And here, the slope becomes one. That is why the line becomes vertical. If the slope is one, the line becomes vertical, correct? So through this also in a mathematical expression, we have discussed about the slope, students. Okay. Now, sir, intensity of change in call put option is higher than the change in spot price. No, it cannot. It cannot happen in that way. Okay. So the maximum change we have denoted is equal to 1, students. So we are saying that call option delta increases from 0 to 1 as its stock price increases. Okay, let me just mention here delta moves. For students, please focus here. I'm giving you one question. Okay, so you tell me the answer. So call option, we understood delta moves from 0 to 1 as the stock price increases. In case of a put option, delta moves from 0 to dash. Please tell me what is this dash? As its stock price decreases. Okay, so input option, if the stock price decreases, then only delta will move from 0 to dash. What is this dash? Tell me. So in case of a put option, students, what do you feel the delta will move to from 0 to where? In case that stock price decreases, students. Oh, very nice. I have some good answers. Tanisha and Shruti, perfect. You guys are absolutely right. It will move to -1. Okay. I hope all of you will never forget this. And this can even also be proved from this again payoff diagram for option here. Correct? Here it moves like this, right? So this is 0, correct? Then this slope is actually -1, students. And this slope in between is actually less than 0, but greater than -1. Okay, or I can say 0 to -1, students. Yes, Shailesh, Mansha, very good. Namrata, just check once. It will move to -1, Namrata. Okay, not +1. So, can we say that if it is out of the money, delta is 0, and if it is in the money, it is -1. So, lower the spot price, put option would be in the money, hence delta would be -1. Okay. -1. Why -1? Okay. See, Namrata, we said that -1. So delta of put option is -1. Correct, Namrata? We discussed that. If delta of call option is +1, delta of put option is -1. So it will move from 0 to -1, not 0 to 1. The moment your stock price will decrease, okay, the stock price will decrease will mean what? In the numerator, let's say you had a price of 40, your value of put is 2. Now you had a price of 38, your value of put will become 3, correct? Now what will you do? You will do 3 minus 2 in the numerator, and in the denominator you will do 38 minus 40, correct? So this is 1 divided by -2. So this is actually minus 0.5. You got my point? Put option always delta is negative, hence it will reach to -1, Namrata. Now the last thing in delta I want to tell all of you is delta is equal to hedge ratio, students, and put delta is equal to call delta -1. Always remember this relationship, students. Okay. Put delta is equal to call delta -1. I hope, Namrata, -1 is clear now. And this relationship, all of us should remember. Okay. So delta was the biggest factor. Actually, delta is the biggest factor to discuss also. Okay. Yes, students. Now let's move ahead. Let's come to the second Greek. So the second Greek is called as gamma. Okay. Now what is gamma? Gamma actually measures the rate of change in delta as the underlying spot price changes. Okay, Tanisha, please explain the equation. So, Namrata, this is actually minus n minus d1, correct? And n d1. Okay. If you have any specific values for normal distribution table of minus d1 and normal distribution table of d1, this will always be 1, correct? As I discussed that. So this is just again the area from left to right, right to left, like that. If you have minus d1 and minus in front of that and d1, it will always be equal to 1, Namrata. Okay. Tanisha, you are saying call. Yeah, this one, call option in delta. This is the graph, Tanisha. Okay. Let's go to gamma, students. measures the rate of change in delta as the underlying spot price changes. Okay. Because what is happening, students, the delta is also not same as the delta changes. Because we discussed, right? It moves from 0 to somewhere between 0 to 1 and then finally 1 from out of the money, correct? Out of the money to add the money to in the money, right? So as the delta changes with changes in spot price, gamma measures the change in delta with change in spot price. Okay, students. Now, gamma is actually the highest at the money option. Students, can you imagine why? Because for at the money, the options once it crosses from out of the money to add the money to in the money, then the delta changes very fast, right? So the delta change will be highest when it is at the money. However, deep in the money and deep out of the money would have low gamma. Simple. Because deep out of the money and deep in the money, always delta will remain 0 and 1. Deep out of the money, delta is 0. Deep in the money, delta is 1. And there is no change in that. So in that case, gamma will be low. Okay, students. I hope this is clear till now, students. So just remember, students, gamma is always highest when the option is at the money. The option is crossing at the money, whether it is a put option or whether it is a call option, students. Okay, so for gamma, if we want to express gamma, change in delta divided by change in spot price. So in a way, gamma actually measures the change in the change, the delta of delta. Okay, so the gamma is delta of delta. And we knew that delta is equal to change in the call option divided by change in the spot price or change in the put option. Change in call option or put option divided by change in spot price. Okay, students, I hope this is clear. So students, as I told you that Greeks are what? Greeks are, okay, let us go to the Greeks. Greeks are factors affecting the price of the option, students. Okay, now what are the factors? First factor we discussed, which is the spot price. Spot price, its implication on delta, delta and its implication on gamma. Correct? Everything is clear till now. Now let's go to Vega. This is the third Greek. Okay. So what is Vega? Vega is actually sensitivity of option price to the changes in volatility, which is the standard deviation, which is V actually. It is again stemming from the same thing. What we understand, D1 is equal to natural log of S by X plus R plus V square divided by 2 into T whole divided by V under root T. Correct. So wherever this V is there, it will lead to higher D1, and higher D1 will lead to higher ND1, and higher ND1 will lead to higher value of call option, students, that we discussed, right? So value of a call option is dependent on its volatility. Volatility is standard deviation. So the standard deviation, if it changes, it will change the value of the call option also. Okay. Then this is all about Vega. Okay. Then fourth one is actually rho. Rho is equal to the sensitivity of options price to changes in the risk-free rate. So rho is sensitivity of option prices to changes in the risk-free rate. Correct, because again in the above formula, there is a R percentage also. So this R percentage is the risk-free rate, students. Correct. So the rate, if it goes up, so the call option value will also go down and put option will value go down. It has an inverse relationship, students. Rate here, if it goes down, call option will also go down. But the put option will go up, because the value of call option was SND1 minus X raised to the power RT ND2. Correct? So here higher the rate, higher will be the present value factor. And if it is higher, then it will make this entire component lower in the equation, and hence the value of call will be higher. Okay. However, in the case of value of put, this is beforehand, right? So X raised to the power ERT N minus D2 minus Sn minus D1. This is the value, right? For put option. So if it is higher here, it will lead to value of put option to be lower. If R is higher, then value of put option will be lower. If R is higher here, then value of call option will also be higher. Okay, students. I hope this is clear to all. Okay, students. Then lastly, theta. Theta is actually the sensitivity of option prices with the passage of time, students. Okay. So which is actually T in the equation. So if time lapses, the option prices, how it will move, that is the Greeks given by theta. So this is the fifth Greek. Okay, so delta, gamma, vega, rho, and theta. These are the five Greeks. Okay, students. Let's break for 10 minutes. We will again reconvene at 8:36, students. Thank you. let me just quickly summarize the Greeks and then we will move to the other parts of derivatives. Okay. So, students, on Greeks, we discussed five Greeks, right? Starting from delta. Delta is the Greek for spot price. Then we studied about Vega, which is the volatility related Greek. Then third one was rho, which is the rate of interest. Then was theta, which is actually related to the time passage. And last one was related to delta, which is gamma, which is the change in delta. Delta in delta is actually gamma. Okay, students. I hope the concept of options is clear, students. Okay, let's move ahead. Now, let us take on to some of the new topics that has been added this time in the course, students. So we will start with them, and some of them are interrelated to what we have studied earlier. So now onwards, you have to just listen, and you have to just listen carefully and answer the questions that I'm going to ask. Okay. So students, there is a new topic this time that has been introduced is on the credit derivatives. This is actually very interesting topic, students. Credit derivatives, and very easy to understand. So let me start. Let us take any asset, an example of any asset. Okay. That asset, that asset have two risks, primarily two risks. Okay. Let us take an example of bond. Okay. Let us take an example of bond. So there are two different types of risks, students. As we understand, one is called as market risk, and second is called as credit risk. Okay. I'm saying generally we can club all the risks into two parts. One is market risk and second is credit risk. Now, what is the difference between market and credit risk? So students, market risks are the risks that are related to the price, let's say of any index. It is related to the interest rate of that country. It is related to the stock market, which is what I have mentioned here in the form of price or index. It can also be related to the exchange rate changes. Correct, students? So the market risks will have all these components. Till now, whatever forwards, futures, and options we have studied have only been able to cater to such market risks. Okay. Forwards, futures, and options have catered to such financial part of the market risks. Correct? They have covered the financial part of market risk. For example, if the price was there was a risk of price going down. We have suggested to short a forward, short a future, or purchase a put option, or even short a call option. Correct? These four options, four or five options, we have discussed at length in different questions. So the market risk is actually catered by the discussions that we had till now. There is a credit risk also. Now, this credit risk? Credit risk means the non-payment risk. Let's say today I have given some money to Mr. X. Now, and that money I have given for 5 years with the interest rate of 10% per annum. Now I expect that Mr. X should pay me money back after 5 years, and till the end of 5 years, he should also pay me the interest. Now, what if Mr. X goes bankrupt? Or what if Mr. X is having sufficient cash flows to pay me that amount? That is called as non-payment risk, or we also call it as credit risk. We we can actually name it counterparty risk, in which case the counterparty is not able to oblige once the time comes to pay that amount. Similarly, we can also call it as default risk. Correct, where the counterparty is actually defaulting. And the nutshell is it is because of the non fulfillment of obligation by the counter party. Students, I hope the genesis of credit risk is clear. See, before we go to credit derivatives, we first need to understand that what is the problem statement here. Okay. The problem statement were two. One is market risk and second credit risk. Market risk, I said that in the definition of market risk, it seems that we have covered it fairly under the previous parts of the forward futures and options, which has covered. Now, the credit risks are something which are new to us, because practically it's not that the credit risk is not there. Credit risk is always there. We have taken an example of bond. Okay, so for bond, let's say the market price is changing, or let's say the interest rate is changing, the yield is changing, so that will change its market price of the bond. However, we have to be also cognizant of the fact that once the maturity comes, the issuer of such bonds might not be able to repay back amount. That is governed by credit risk, student. Okay, I hope the problem statement first of all is clear. Now, we have this problem of credit risk in front, right? The derivatives to used to hedge against the credit risk are referred to as credit derivative, students. So credit derivative, those instruments that are used to do certain actions on hedging and other things for the credit risks. Correct, because credit risks was unexposed till now. Correct. So in our curriculum for credit derivatives, we have to understand broadly two instruments. One is collateralized debt obligation, which is called as CDOs, and second is credit default swaps, which is called as CDS. Credit default swaps and collateral debt obligation. Okay. Perfect. Collateralized debt obligation and credit default swap. We will take you through the exact understanding for such credit derivatives. Okay. So first of all, on collateralized debt obligation, students, I would want all of you to please recollect our securitization knowledge. Okay. In securitization, what we discussed, there is an originator. So let's say here is SPV. Here is originator. And here there was a borrower. And borrower has taken off, let's say, mortgage loan, right? We said it was a home loan. Home loan is mortgage loan where the home is kept on a mortgage, and originator will sell such mortgages to SPV, assign mortgage to SPV, and then SPV will issue marketable securities to investors. Correct, students? Marketable securities to investors, which is having an underlying of these mortgage loans. Correct. And hence we called them as mortgage-backed securities. These marketable securities were referred to as MBS, mortgage backed securities. Correct. So this understanding, we securitization, right? There is nothing new. I have told you in all these things we have covered over there. I've just brought it. Okay. Now, these mortgage backed securities were those securities which have an underlying as such mortgage loans, because those are transferred to the SPV and SPV will issue marketable securities against them. That is point number one. So students, there is something called as asset backed security also, ABS. This is called as asset backed securities. So generally this asset backed securities will have all types of loans. So mortgage backed securities have, right? So asset backed securities might have car loan as an underlying. Okay. So any other asset as an underlying, in this case, other than mortgage, will be a asset backed security. Okay. Even on a car loan, there will be an originator, there will be a borrower, and instead of mortgage loan, it will be a car loan, and it will be assigned to an SPV. SPV will issue investors a backed security. So car loan is just other things also. There can be other assets. It can be bonds. It can be tradable securities. It can be anything. Okay, the bonds that are invested. You're getting my point? So those all will also form part of the asset-backed securities. Now, collateralized debt obligation, CDO, can include MBS or ABS both. Okay. The collateralized debt obligation can be relevant for MBS or ABS both. First of all, that is the first point, students. Now, for the moment, I am keeping this asset-backed security on a side. Let's take our discussion on mortgage-backed securities ahead. Okay. Now, if you see these investors, what we have also discussed. Okay, let me just make a clean chart actually. Originator, SPV, investor, borrower. Okay, and we're about mortgage loans of how much? We said, right, that let's say we have given loans to 1,000 numbers multiplied by let's say 1 crore each. So this is a loan book value of 1,000 crores. Correct, we're talking about such numbers. So 1,000 numbers of loan we have given to different 1,000 individuals who are borrowers in such a case. And 1 crore was the individual loan amount, and hence 1,000 crore is the loan book value. Now this originator has assigned to SPV, correct, such book value of 1,000 crore, and SPV has issued MBS, mortgage backed securities, to investors. Now within investors, they have specifically called out for the rating agencies to rate, correct? So the rating agencies would have rated this 1,000 crore book value as let's say AAA or let's say BB or whatever they think, correct? As per their process, they would have gone through and checked these amounts and hence have them an overall rating. Now, what investors are there? So there are multiple investors in this. Okay. As I said that there is an investor called pension funds. Okay, so what are the pension funds? Pension funds are those where the collection of pension is pulled in and they go out for investing. And whenever an employee retires, they will liquidate their investments and pay out to the employees. Correct? Like our pension is with government. Similarly, EPF, like the employees provident fund, right? Or the public provident fund, right? Within that, there is a pension fund. So pension funds or let's say provident funds will have the amounts to be invested because they will have the collections from all the individuals like us. Similarly, there is a let's say I can say a bank, and lastly I can say there is a high net worth individual, HNI, which we call as high net worth individual. Correct? High net worth individual are such people who have very high private assets, funds. Now, just the arguments that pension fund bank are giving. That I am very risk averse. I don't like risks. I want a constant return of 4%. Okay. On whatever you have. And if there is a default, I will not take any default. So this SPV says that, okay, I have 1,000 crores. I have given it to 1,000 different people. Again, applying the portfolio management principles, it is not that all of them will go bad. All of them will not go bad. Let's say 80% will be okay. There is no default on 80%. 10% might default for the interest. but principal is secured, and another 10% there will be a complete default where interest as well as principal will not be recoverable. Okay, so SPV would have done this calculation already, and they will say that okay, 80% are giving me now. So then let me do one thing. Let me actually to the investors. So SPV is talking to investors. Now investors, there are these three groups. Three investors, pension funds, bank and HNI. Pension fund is saying that I need a steady return of percent. I have gone through your book value of the loans. To me, I just need a steady return of 4%. I don't need anything else. Then bank says that I need a steady return of 6%. Okay. Because it says that I'm okay to take some sort of a risk on this 10% people. They go bad, you don't give me anything amount. But if till the time the return is coming, I will expect 6% because I am undertaking another 10% who are interest rate defaulters, who can be interest rate defaulters. These HNI says that you do one thing. You pay whatever you want to pay to pension funds and bank, whatever is their balance return, the maximum balance return after taking off fund expenses, you pay us that. And broadly, they have kept a figure, let's say it is coming out to 10%. Broadly, they have kept a figure that is coming out to 10%. So now SPV is under trouble because SPV is saying that I have now three different people. Sorry. I have to deal with pension fund. Sorry. I have to deal with pension fund, which is asking for 4%, with a bank who is asking 6%, and HNI who is asking 10%. So within them, HNIs are having high risk appetite. They are having medium risk appetite, and they are having low risk appetite, right? The lowest of them is pension funds because pension funds are dealing with some others people money which has to be paid back on retirement or as and when the rules are there. Students, till now it is clear. Then I will move ahead. So this story is clear till now, or I can say the case is clear. Now SPV, the way SPV wants to take it ahead is SPV will say that okay, I let me also read my book value. After reading upon the book value, SPV is confident that I will have 80 10 10 the way I've mentioned. So SPV, what it will do, it will just simply create tranches. Okay, it will create three different types. Tranches mean types. Okay, the tranche mean there are three different types. First, it will say senior. This tranche is called as senior tranche. This means that seniors will get a minimum return of 4%, a fixed return of 4% without assuming any risk. Second is called as mezzanine. Mezzanine means in between layer, mezzanine layer, right? So mezzanine is in between. So here they will assume some risk, but they will get a rate of 6. Then lastly, senior mezzanine and then junior. So students, junior or let's say equity, let me not put it junior, wait, they are not junior, they are equity. So equity tranche is left with such HNIs who are high, who are having high risk appetite and who want highest return in case the books is not defaulting. in case the bank loan is not defaulting, students. I hope this is clear, students. So, so SPV has come up with three different tranches for different kinds of investors, and it says that, look, I have created three different tranches for the same asset back, for the same mortgage backed loans, right? Now you decide whichever you want to invest. Senior will have again fixed return. Similarly, equity variable return, which is actually dependent on the portfolio's performance. What is the portfolio here? Portfolio is the mortgage loans. Correct, friends? Clear till now, students? Shall I move ahead? Now, the CDO is actually, this part of the process is called as CDO, collateralized debt obligations. Debt obligations, students. So, collateralized debt obligations is simply converting the ABS and MBS, asset backed securities and mortgage backed securities, into different tranches, right? Because what you have ultimately done, you have ultimately splitted out your credit risk. What was your credit risk? For this 20%, there was a credit risk. Correct me, students. 20%, 10% for interest, and 10% for interest plus principal both. There was a credit risk, students, right? In our example. So what they have done, they have split out the credit risk from senior. Senior, there is no credit risk. Mezzanine, there will be some amount, and equity will have the 100%. So in a way, the creation of three different tranches, which is the process called as collateralized debt obligation, has assumed the credit risk and treated it. Okay, students. Otherwise, whatever had happened, so let's say if not tranches, then only one option would have been there. What would have been that one option? One type of MBS, mortgage backed securities, which will have the credit risk also, which will credit risk. So with CDO, we have treated the credit risks. Okay. Now, students, there are different type of CDOs. Okay. And again, I'm telling that for CDOs to happen, we talk about both ABS and MBS. Okay. MBS we have discussed, which is the mortgage backed securities. Now ABS will have, let's say, other things also. For example, pool of also have REITs, correct? Investment funds, whatever investment funds are there. Then even other CDOs are also part of ABS, and hence they can also be a CDO. So CDO can be also on further CDO, right? You are getting my point, students? So MBS is actually mortgage. Okay, students, clear? Now, we were talking about types of CDOs. Okay, types of collateralized obligation, students. First one is the cash flow CDO. Cash flow CDO is cash. Sometimes it is called as cash CDO also. Okay. So, students, in this example, okay, let me just put here. There is an originator and there was SPV. Correct. So, originator, if it sells the underlying to SPV, it is called as cash CDO. If the originator sells the underlying to SPV, which is the mortgage loans, which is the asset backed loans, if everything is transferred to SPV along with all the economic rights of that loans and along with all the economic properties of that loan, it is called as cash CDO. Okay, students? Because the cash flow has happened. Second, synthetic CDOs. So synthetic collateralized debt obligation means that there is an originator and there is an SPV. Okay. There is an originator and there is an SPV. Now the originator will not transfer. Originator will not transfer the underlying to SPV. However, originator will transfer the credit risk of such underlying. Okay. So here, what originator has done, this is a synthetic CDO. Synthetic CDO means it's not a cash CDO, first of all. So originator will only transfer the credit risk associated with that underlying to the SPV students. Okay. Now, how it can transfer a credit risk to an SPV? It will say that, hey, look, I have 20% of my overall portfolio, which I assume to be a problem portfolio, which is there is a risk of default, risk of non-payment. So you do one thing, you take the risk with you and I will pay you a premium, right? And hence, then you, whatever you want to create different tranches on this basis, the CDO operations that we have discussed, I will not transfer you the original assets, which is the original mortgages to you. Okay. So in a way, in cash CDO, it is said that in cash CDO, okay, the collateral assets are moved away from the balance sheet. In synthetic CDO, no actual transfer of assets. Instead, only economic effect is transferred, students. I hope this is clear, students. So the difference between cash CDO, synthetic CDO, I hope it is clear. In a way, the entire CDO process is also clear. Now let's come to some of the risks that are involved in a CDO. Students, if you will listen carefully, then it will be easier for all of you to go through the text that is mentioned in the study material, okay? Because the conceptual understanding I'm giving you here, then maybe all of you can go through the text later on. But to understand those terminologies, to understand those flow that the way it is mentioned, you just need to understand the parts that we are discussing here. Now, even in CDOs, there are some risks involved, right? If let's say, if someone is investing in CDOs, right? What were the CDOs? The three different tranches that we had: senior, mezzanine, and equity. So what are the risks? First one, there is a default risk. Okay, again, in case of default risk, we also call it as credit risk, right? Now, if the underlying party is not paying, if the party to the underlying, the borrower of the underlying is not paying, then still there will be a default. And in case the prime sufferers will be whom? The equity people, correct? So the prime sufferers will be equity tranche, right? So the equity tranche will be the prime sufferer in case of a default risk. Default by whom? Default by the person who has taken the loan. Interest rate risk. Interest rate risk comes if, let's say, the interest rate changes. Because in case the interest rate changes, the value of bond changes, and hence the value of CDO will also change, right? The value of the securities that has been issued will also change, right? So this is also called as basis risk. Then next one, liquidity risk. Liquidity risk, students, means that the securities that I have purchased is not, so basically that security will have the receipts in the form of underlying paying to the SPV, right? And there will be payments, that is SPV paying it to the people. So the receipts will not be, the timing of receipts will not be equal to the timing of payments. Clear? Prepayment risk. In case of a prepayment risk, the holder, or let's say the borrower, actually prepays the amount. In that case, the cash flows will become distorted. Okay. Then reinvestment risk. In case now the surplus amount has to be reinvested. So there will not be any adequate opportunity to invest your amounts beyond what is there in your existing CDOs. And lastly, there is a foreign exchange risk also. Students, foreign exchange risk will come where there will be cross-border CDOs. Namrata is saying synthetic CDO not clear. Namrata, synthetic CDO is basically a CDO in which in the previous examples we have discussed that originator is transferring the entire asset book value to SPV and SPV is paying upfront to originator. Correct? In this case, originator is not transferring the underlying to SPV. That means the originator is not transferring the loan to SPV. It is only transferring the credit risk of such loan. Okay. So in a way, in cash CDO, what will happen? The person who is transferring those amounts will move away from the balance sheet of that person. In synthetic CDOs, the actual transfer of the assets is not happening at all, so that the balance sheet will remain as is. The amount appearing on the balance sheet will remain as is. Instead, only the economic effect is only transferred. Okay, students. So these are the risks that are there for a synthetic CDO. Let's come to credit default swap. So this is second type of credit derivative, credit default swap. Okay, students. So the credit default swap. So these three terms, credit means again loans, default non-payment, swap means we are exchanging. Okay, we are exchanging the amounts. Now, how does it again, students? Let's say there is a party called protection buyer, protection seller, and then there is a term called reference obligation. I will tell all these three things so that the credit default swap is clear. So, reference obligation, first of all, students, is what? Reference obligation can be bonds, corporate bonds, correct? It can also be the corporate debts. Okay, it can also be a loan, any kind of loan, or it can be any kind of a trade receivable. So students, any type of credit, whether in the form of loan or whether in any form, can form part of this reference obligation. So Namrata, I'm coming to that. Okay, Namrata is asking why SP will purchase credit risk only. So this is done through credit default swap, Namrata. Okay. And even in synthetic CDO, the transfer of credit risk happens through credit default swap. So you will be able to understand once you go through this credit default swap. Okay. Partial derecognition from book synthetic CDO. Yes, Mancha, there is a partial derecognition, not 100%. So the reference obligation can be bonds, corporate debts, loans, trade receivables. Even in CDOs, we have studied about the mortgage loans, right? Correct, students? These all things is what we have discussed. So first of all, there has to be a reference obligation. Now that reference obligation, this protection buyer is actually exposed to the credit risk for reference obligation. So protection buyer is exposed to the risk of reference obligation. Risk means credit risk. We are talking about credit risk, okay? So I'm just clarifying. Protection buyer is exposed to the credit risk of reference obligation. So that means this protection buyer in its balance sheet, these all assets are coming in the assets, okay? I mean, these all reference obligations are coming in the assets. So protection buyer will approach to the protection seller and say that, hey, I will pay you a periodic premium. And this periodic premium is, let's say, 0.5% of the loan value that this protection buyer has undertaken, correct? And in return, protection seller need to cover protection buyer for any default on reference obligations. Clear, students? So if there is any default on such reference obligations, so the protection seller will make good the default to protection buyer. In return, protection buyer will pay a periodic premium, let's say 0.5 percentage of loan. For example, let's say there is a loan of 10 lakhs at the rate of 10% per annum. This is the reference obligation. Okay. Now the person who has given such a loan would say that, okay, since I'm giving a loan to double B rated person, let's say this loan is given to an entity called A Limited. That A Limited is double B rated. Double B rated means that there is a risk of default. There is a high risk of default because triple A is always best. So if it is not triple A, it is double B. So let me go to a protection seller and tell them that in case this A Limited defaults, then you pay me the defaulted money. Okay, then you pay me the defaulted money. Okay, students. Now this protection seller and protection buyer. So this protection seller is just like giving an insurance, right? Similar to insurance. They are giving similar to insurance and hence they are charging the premium. Okay. However, this protection seller itself should be credit rated because what if tomorrow protection seller also goes bankrupt? Then they are receiving the premium, but while they have to pay to the protection buyer, they will not be able to pay. So hence they also need to be credit rated. Okay, students. So in our study material, these are called as initial borrowers. So the people who borrow through through reference obligation are called as initial borrowers. Buyer is this one and seller is this one. Okay, students. I hope this is clear. Now, the settlement of CDS happens in two ways. That is mentioned in the study material again. One is the physical and one is the cash settlement. So in our derivatives, we have studied about gross and net settlement. Gross settlement is where the physical delivery of shares will happen, right? And the gross amount will be paid. So physical settlement in case of CDS is where the delivery of bonds or underlying on which CDS is taken will be done and 100% payout will happen. Here only differential payout will happen. That's all. So it is just similar to net settlement. The cash settlement is similar to the net settlement and physical settlement is equal to the gross settlement, students. Protection buyer, Namrata is asking who can be a protection buyer. Protection buyer can be the person who has given this loan. Or in our case, originator, in this case, CDO, originator will become protection buyer in case of a synthetic CDO. Okay, because the credit risk will be transferred to SPV in the form of credit default swap. So this protection buyer has actually swapped the default in the credit that this protection buyer has given to the protection seller, students. Okay. So with this, the credit derivatives are over, students. Is there any other doubt, students? Please do let me know. But the process is this. So credit derivative, students, how we started our discussion is that in case of any asset, there are two risks. One is the market risk and second one is the credit risk. So the market risks we have already covered in the financial part of the futures, forwards and options, which is essentially the price risk, which is the interest rate risk, stock exchange risk, all those things, and even the foreign exchange risk. So students, you will cover up the foreign exchange part in your upcoming sessions on the Forex. Right. So there you will get to know about the forward futures and options coming on Forex also. Now on credit derivative, on the credit risk, we said that credit derivatives are designed to make sure that the credit risks are eliminated. There are two ways in which you can do that. One is CDO and one is CDS. CDO is collateralized debt obligation. CDS is the credit default swap. So this credit default swap, we discussed that in this case, the protection will be purchased from a protection seller and this protection will help the person who has given a loan or even not given a loan to help in the risk of non-payment, the amount will flow to them. In case of a CDO, we said that we have used our preliminary knowledge of securitization, where we have said that that will be used to do the different tranches as we discussed about pension funds, HNIs and banks, right? So senior, mezzanine and equity. Equity is also called as junior tranche. So that will be taken up for the payments basis their different risk profiles. And hence that is called as the collateralized debt obligation, students. Okay, Namrata, that's what I just now did. Now let's come to commodity derivative, students. So students, commodity derivative is not new to us, right? Because in the first part of the first session of this derivatives, we discussed that underlying can be anything. Correct. While derivatives have an underlying, so underlying can be anything. It can be a commodity also. So what is a commodity? Commodity is something which, okay, let me say that which type of commodity is taken for derivatives. So students, first of all, what are the common features? It should be durable. If the commodity cannot be stored, correct, then there is no need of a derivative on the commodity. See, because it can be stored, that's why there is a need to do the forwards on those commodities, right? And hence to achieve the hedging. If there is no point in storing it, then whatever price is available, we will have to do the transaction on that. It must be homogeneous. Then only it will make sense, right? Otherwise, if it is not homogeneous, then also it will be difficult that which commodity are we talking about for what specific thing to be traded upon under the commodity derivatives. Then it must be subject to the price fluctuations. It cannot be that the prices are not fluctuating. If the price fluctuate, then only it will make sense, or then only it will incentivize the people to enter into commodity derivatives to curb those price fluctuations. But if already the price is flat, it will not give any use to anyone. Okay, then there should not be any breakdowns. So what I'm mentioning is supply should be consistent. Okay, it should not happen that there is concerns over the demand and supply, or mean concerns over the supply specifically, right? So if these things are generally present in a commodity, that commodity can be taken as an underlying for the commodity derivatives. Okay. Now let's take an example, students. Let's say there is a farmer here. Which this is given in the study material again. This farmer actually produces corns. And there is a company called Kellogg's, which uses corns, correct? And produces an output. Now, if you see farmer who is producing a corn is exposed to which risk? Exposed to a risk of price going dash. Tell me, students, going up or down? So the farmer who is producing a corn is exposed to a risk of price going up or down. First of all, let us identify, students, what is the risk to a farmer? Farmer is producing a corn. Corn, he would like to sell that corn. So whether that farmer is exposed to a risk of price going up or he's exposed to a price of risk going down. What is the problem with farmer? Let us understand. Please tell me, students, whether it will be going up or down. Yes, Mansha, Namrata, Shruti, very good. Price going down. Similarly, this company is actually exposed to a risk of price going up. Because if it goes up, it uses as a purchase, it uses as an input to the output that it produces. So it will also mean that the company will have higher input cost, which will the company would want to avoid. Yes, Mohammed Abdul, price going down, and Namrata, yes, you are also right. So in this case, the farmer was exposed to a risk of price going down. In this case, the Kellogg's is actually exposed to the risk of price going up. Now, what they should do? They should enter into the specific positions in the commodity market such that the farmer is secured and even the Kellogg's is also secured. What will be they? See now, what are the different types of instruments available? One is commodity futures. Again, very similar to the regular future students that we have studied. No change in that. Regular futures, there is a future seller, there is a future buyer. Future buyer is going to be a Kellogg's company. Future seller is going to be the farmer. Simple. And the settlement will happen on a net basis. Correct? Settlement will happen on a net basis. These will be the standard contracts. Okay. However, commodity forwards will be a over the counter contracts that we have discussed earlier, right? So only thing is that in our previous discussion, we have to remove the underlying from equity share to a commodity. And commodity can be rice, can be copper, can be metal, can be pulses. It can be, in this case, corn, it is there. It can be even gold or silver. Okay. And the stock exchange that is dealing with commodity prices is multi commodity exchange. This is also called as MCX students. Okay. Then the second type of commodity derivatives are commodity swaps. So such commodity swaps are that what happens, the commodity prices also keeps on changing. For example, price of a cotton. It is it is like a simple market index, right? Let's say market also keeps on changing the price of the cotton, or let's say any commodity keeps on changing. So while entering into commodity swaps, what we are doing is we are doing a fixed floating swaps. Let's say we are converting the floating price to a fixed price. Let's say we say that whatever is the price floating in the market for a cotton, we fix it to, let's say, 100 rupees. It will not change. So the fixed to floating swap, what will happen? I am exposed to a risk of floating price. I want to convert it into fixed. I will approach someone who is looking a vice versa, situation. They will take the contract with me and they will convert my floating rate into fixed rate. Now, whatever is the floating rate, that person will pay me and I will pay to him the fixed rate. Simple. So this fixed floating swap, student, we will cover in detail in the interest rate swaps in that topic. Okay. Then second one is commodity for interest swaps. So in this case, the commodity price will be swapped to the return percentages. Okay. Let's say we expect a risk-free return of 8%. So the commodity price changes will be linked to this return, will be swapped for this return percentages. So these are some of the topics that are there in the previous course. Also, the commodity derivatives, it was very well there. Okay. But better to understand from both the perspectives. So Mansha is saying oil and electricity. Yes, Mansha, that also we will cover. Electricity we will cover separately. Okay. Now let's come to the next part. So this is all students from commodity derivatives. You would recall we have done certain questions also on commodity derivatives, right? The one question on rice, where the farmer was exposed to a downside risk and we told him to purchase a put option. You remember, because he can maximum accept 5% downward in the prices. Okay. All those questions, students, we have discussed earlier. Now let's come to weather derivatives, students. Yes. So weather derivatives, students, weather derivatives are such derivatives where the underlying is a specific measure of a weather. Students, please understand that there are some industries which are not at all dependent on a weather, but there are industries which are very heavily dependent on weather. By weather, I mean anything specific to weather. It can be a temperature, it can be a rainfall, it can be a humidity, it can be anything, right? Which is a specific measurable amount. Now, let's take an example of, let's say, again, a farmer, because farming is definitely dependent on, let's say, monsoon, a proper rainfall. Okay, so in that case, what happens if farmer whose farming is dependent on rainfall? So what this farmer would do, this farmer will say that, okay, I take rainfall as a underlying. We will specify that rainfall, if it is less than or more than this centimeter of rainfall, then there will be certain payoffs either from my end or to the counterparty's end. Or it can be in the form of a options contract where I will say that, okay, I will pay you premium. Okay. And then you protect me against the adverse movement. If there is a positive movement, whatever premium I have paid to you is sunk. If there is a adverse movement, you pay me the difference. That's how farmer will say. Okay, so let's say the rainfall is an underlying amount. Rainfall is an underlying, question. So they have specified in the contract that if it happens in an adverse movement from what to what range exactly and what to what period exactly, then there will be certain payouts. Okay. Now, in this, students, please remember, any kind of weather cannot go for a weather derivative. First of all, the data should be available. The specific data should be available. There has to be a consistent way of measuring that data. Then only weather derivative can be used. Second, please don't confuse it with an insurance contract. This is not an insurance contract. See, in the insurance contract, what happens? The insurance company says that if there is an earthquake, which is also one form of extreme weather, right? Or let's say if there are floods, which is also one form of extreme weather, then we will pay you your whatever losses happened. Correct? This is an insurance contract. In weather derivatives are not going or not covering the extreme weather situations. So first of all, students, we want to draw a line between an insurance contract and weather derivative. Insurance contract is something separate. Weather derivatives is just simply the derivatives which have a weather as an underlying, and it can, from an outcome perspective, it can be a positive or it can be an adverse. For that, whatever protection we are planning, or for that, whatever instrument are we are planning, that is called as a weather derivative. And these are not at all covering extreme weather situation, students. Okay. One more important point to be noted here is that till now, students, the derivatives that we were discussing, they were actually covering the, just a second, students. Yes. So till now, students, whatever derivatives we were discussing, they were covering the price or value of an underlying, or let's say of any asset, I would say. Price or value of anything. Let's say price of an equity share, value of an equity share, right? In case of that, commodity will be the respective commodity's price, the gold price, silver price, correct? Here, in weather derivatives, we deal with the volume of the loss. So basically, we talk about volume lost. Sorry, student, just a second. Let me. So in this derivative, we talk about loss of volume, not loss of price. So we say that had the temperature been 40 degrees Celsius, okay, had the temperature been 40 degrees Celsius, the produce would have been 40, the produce would have been 50 metric ton. Okay. Now the derivative is if the temperature is more than 40 degrees Celsius, then the person who has entered into that agreement will get the difference of whatever that loss of volume has happened. Okay, students? I hope you're getting my point. So, in a way, we are only covering for the volumes here, not for the amounts. The amounts will be a derivative. I mean, amounts will come from that volume. Okay. So there are certain concerns that we need to keep in mind. One is data. That specifically the data has to be correct. How that data is calculated, from where this, what is the source of that data, all those things needs to be kept in mind before we can conclude that this weather measure can be taken for a derivative purpose. Then forecasting of weather. Students, we know that forecasting of weather is a problematic issue, right? So sometimes we forecast it is going to be something, but it never turns out to be that, or it sometimes turns out to be that. So in that case, also your position of long or short, where whatever you are taking on that weather derivative will also become distortive. And lastly, temperature modeling. So if temperature it remains constant across different months in a year, then there will be an issue in this. So Namrata is saying loss of volume. Please give example. Namrata, as I just discussed, that the contract says that if the temperature is 40 degrees Celsius, then nothing needs to be done. If the temperature is more than 40 degrees Celsius, then the person who has purchased this contract will get a volume benefit of whatever the volume comes, actual volume minus, let's say, 40,000 metric ton minus actual volumes. So you can imagine any kind of contract will do, right? Let's say now the actual volume more than 40 degrees Celsius has come as 39,000 metric tons. So 1,000 metric ton will be the settlement value of this contract. Okay, students. Now, lastly comes the electricity derivative. Students, if you see, electricity is a highly regulated area, right? So electricity is produced by the electricity producers and they are sold to the government related companies through a power purchase agreements, right? So PPAs we call, so these are power purchase agreements. So the producer of this electricity will sell the electricity to the government's company. Yes, students. So we were discussing on electricity derivatives. If you see the Indian scenario, mostly the electricity is purchased by the government or the government agencies through a power purchase agreements. Now, so this is on the supply side. Now imagine someone who needs a very big power consumption. So that is on the consumption side, right? So for both of them, the prices of electricity matters a lot because let's say for the output, for the person who's producing electricity, the output is in the form of electricity. If the prices goes up and down, there will be a good amount of risk into the P&L. Similarly, on the person on the consumption side, if the prices increases, fluctuates heavily, then the input prices will also increase. So spot price of electricity is actually dependent on lot of things. Let's say if the electricity is produced through a coal, so availability of coal, correct? Then weather conditions. Similarly, coal is one thing, but again, there are some other fuel related supply constraints. So all these things will actually keep on changing your spot price for electricity, which will be a problem area for electricity producer as well as the companies who are consuming electricity at a bulk. So with this problem, now the problem is clear. With this problem came the electricity derivatives, where the underlying becomes the spot price of electricity students. Okay. And again, with the similar understanding that we did till now for all the derivatives, there are three major products that we have studied: forward, futures, and options. So similarly, for electricity derivatives, all these three are there: forward, futures, and options. Now, students, we would have seen, I mean, for some of the companies who are electricity in the electricity production, they do a power purchase agreements for almost 20 to 25 years. Okay. And in that, they will fix up the rates. or if not fix up the rates, they will identify how to calculate it. So it is one kind of a forward agreement, right? Because I'm not sure if I sell and if I agree after 5 years, what would be the rate. So better I agree today basis that forward agreement, right? So, I mean, the concept remains same for forwards, futures and options. The underlying in this case becomes the spot price for electricity students. Only one thing which I need to discuss here is on the electricity swaps, because this might be certain new thing that as an analogy was not discussed earlier. So electricity swaps. So whenever we say about swaps in this particular case for electricity, it will mean that whatever is the floating rate, it will be substituted by a fixed rate. Okay. This contract will convert the floating rate into a fixed rate. Okay. Why it will be happening? Because the floating rate, we really never know when it will float and become higher. Fixed rate, at least we are secured. We know that this much we need to pay. Okay. So students, again, I'm saying the swaps part in detail, we will cover under the interest rate swaps, right? Where we will be covering the practical questions also. But as of now, to understand what is swap is, it converts or it exchanges the values from a floating to fixed or fixed to floating, vice versa also. Okay. So that will convert, and hence it will help us to hedge against the floating rate positions. Okay, students. So I think with this, uh, I've covered today beyond the options. One is the credit derivatives. Okay, where we said that credit derivatives are used to hedge against the risk of credit, right? Which is CDOs and CDS, collateralized debt obligation and credit default swap. Then we discussed about the commodity derivative, weather derivative, and electricity derivative, students. So with this, the today's discussion from my end comes to an end. I request CA Ashish sir, who is there with us, to help us with the concluding remarks. Thank you. Sir, I think you are not audible, sir. Okay, anyway, sir, voice is not coming. Okay, so students, we will end the session today here. Okay, so yeah, thank you all for joining. Please do the revision of the concepts well. Okay, thank you. Technically, session is over. नहीं नहीं उनका वो सो आई थिंक उनका मैसेज आया है, देयर इज सम प्रॉब्लम, सो वी कैन एंड द सेशन. थैंक यू.
Recording stopped.